Good afternoon, everybody, and welcome to the latest in our series of Professional Advisors Working Lunches. Today, brought to you courtesy of our partner, Baillie Gifford. I'm Jenna Brown, Deputy Editor of Professional Advisor, and I will be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. The microphones and cameras are currently switched off, and we'd be grateful if you kept them that way. It will ensure there is no background noise, so the speakers can be heard more clearly. I should also inform you that the session is being recorded, and we'll send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. Today, we're going to be talking and learning about growth investing for a sustainable world. Investment specialist Alasdair McHugh will be discussing how the Baillie Gifford Sustainable Growth Fund harnesses powerful positive feedback and drives meaningful outperformance over the long term. But what does this mean? Baillie Gifford says it looks for companies that are sustainable in both senses of the word, delivering enduring growth and enduring good. It says it does this against a backdrop of broken ESG investing, but it is an achievable aim for managers that have a wide perspective on sustainability. Do feel free to put any and all of your questions to Alasdair using the chat function, which you will find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. So, just before I hand over to Alasdair, let me run you through our learning objectives for today. By the end of this session, delegates will understand the biggest predictor of long-term share price outperformance, be able to reframe sustainable investing as a world of opportunities rather than downside protection strategy, and have learned how businesses can be impactful not just through its products and services, but through its business practices too. So that's the CII and CPD covered. Let's hear from Baillie Gifford's Alasdair McHugh. Good afternoon.
Hi, Jenna. Thanks for having me. I think that's a very helpful introduction. I am an investment specialist in our sustainable growth strategy. I've been working in sustainable investing since 2015, so before it was cool. And frankly, I'm a little disillusioned with the direction it's taken in recent years. So I think that the industry, responsible investing industry specifically, has become pretty backwards looking, pretty focused on ticking the right boxes. And I would say always sort of striving to quantify what is inherently unquantifiable. I think there's a lot of funds out there that are sustainable by name, not necessarily by nature, fairly superficial attempts at asset gathering, rather than trying to find a solution to clients' needs. And I think that risks undermining what we're trying to do within the responsible investing community, what we're trying to achieve. And I think for the advisors out there, it makes it very difficult for you to see what funds are honourable and which ones aren't. But I do think that also presents a bit of an opportunity, to try and do something that is focused on clients' needs, to try and do something that's more thoughtful, more insightful, and ultimately more forward-looking and focused on the opportunities. So what we're trying to do is provide a portfolio that clients can be proud of, both for its financial returns and for its sustainability credentials. That's what we set out to achieve with the Sustainable Growth Fund. And as Jenna helpfully said, we describe it as a portfolio that's sustainable in both senses of the word. And I like to use the phrase enduring growth and enduring good. Those are the two things that we're trying to deliver here. We're pretty uniquely placed to do that because we have a corporate structure that allows us to run our business with at least a 10-year view, if not more. And the culture that flows out of our partnership structure is very supportive of that and facilitates investing over similar time horizons. I think it's only over those kind of periods that the power of compounding can really work its magic. And crucially for sustainable investors, it's only over those timeframes that a company's contribution to society is also properly reflected in share prices. So today I'm gonna outline how we go about putting that into action and trying to do something that's more honourable than a lot of the funds that are out there in the sustainable investing space. But first of all, we were going to kick off with a poll question, which either Jenna or Elena were going to share. And I think the poll functionality was maybe defeating us slightly. So perhaps the best thing to do is if we can post that into the chat and people can respond to it in there. So I'll just give you a couple of minutes to respond to this. The question is, it's a bit of market research for me, if I'm honest. What are your clients' attitudes towards sustainable investing? So are they desperate to see their capital change the world? Would be answer A. Answer B, are they just keen to avoid supporting the kind of industries that are harmful for the planet or for people? And answer C is, are they simply fearful of compromising on financial returns? So I'll give you a second or two just to type 1, 2, or 3 in there, and I'll try and get a flavor of it without the poll functionality. I don't need to give you much longer because almost everyone has said to, which was, avoiding harm broadly. And that's sort of broadly what I expected. We did do a lot of our own market research around this strategy. And quite recently, we looked at that and we came to the conclusion that clients really wanted an option for a core allocation to growth equities that had very strong ESG credentials, but that didn't compromise on the financial returns at all. So what we've done is we've very deliberately structured our funds according to that. So it's a portfolio that's more diversified than your typical impact fund, so can be a core holding, but it also has a single financial objective, one that makes it very clear that you can do well financially by doing well, by doing good by society. So I'll get into a little bit of that in a second. What I'll do is perhaps just share my screen so that you can see the presentation. So hopefully this works. And someone chip in if you can't see these, but what I'll do, I'll scroll through them. And forgive me for starting the presentation by talking about ourselves. Never a good way to start, I don't think, but I do think talking a little bit about Baillie Gifford is important because it really is the thread that runs through everything that we're trying to do. We're able to do something different in the responsible investing community because we are different as an organization. Now, that's in part because of what we're not. So we're not a PLC. We have no shareholders pushing us to meet the next quarterly AUM target. And that means we can be truly long-term in the way that we run our business. So, whether that's continuing to recruit investment graduates throughout the financial crisis, throughout the pandemic, or whether it's closing very popular strategies to new business, we've demonstrated over the years that we very much run our business for the long term. Now that sets the tone for our entire firm, and it allows our investors to think truly long term in the way that they approach their research, the way that they make their decisions. And of course, they're incentivized over periods of at least 5 years. So, very much not about the next quarter or even the next year. We've got stability in the middle of the slide there. That's really about the fact that an unlimited liability partnership structure gives you pretty tremendous stability, we would say. So we've got 57 partners, I think, at the current time, all of whom work in the firm and none of whom own more than 10% of the firm. We've never engaged in any mergers and acquisitions. Our staff turnover is consistently around about 5% amongst investment professionals. So that kind of stability is something that's very highly valued by our clients. And it's probably why our first client is still with us all these years later, 115 years, I think it is at the minute. And I think, most importantly for you on the other end of the call, chomping into your sandwiches on this working lunch, I think that partnership structure creates really good alignment with our clients and with your clients underlying. Active investment management is the only thing that we do. It's our only line of business. We simply have nothing else to fall back on if our investment results aren't good for a prolonged period. So, if we don't do well for your clients, we don't do well ourselves. And I think that's something that people take quite a lot of comfort from. So the reason I'm showing you this and talking about ourselves very selfishly up front is because, we think that the partnership structure at Baillie Gifford is the ideal structure for long-term investing, and that long-term investing is the only way to do sustainable investing. Now, I'll just move on to what we're trying to do specifically within the Sustainable Growth Fund. And I used this phrase already, sustainable in both senses of the word. We believe that a company that can deliver really meaningful growth over long periods is better placed to have a beneficial impact on society. And that those companies that are a benefit to society are in turn those that are best placed to grow. So what we're trying to show on this slide is that that's a virtuous circle. We're looking for those companies that are sustainable in both senses of the word, that they have that enduring growth characteristic, so compounding their growth over genuinely long periods throughout and across economic cycles. But they also have the enduring good characteristics, so contributing to better outcomes, not just for shareholders, but for a broader swathe of society. And because those two things are self-reinforcing, that allows us to pursue that single financial objective for our clients, and really reassures them that we're not compromising on financial returns to deliver the enduring good element. So the next couple of slides really delve into that in a bit more detail. We're sustainable in both senses of the word, enduring growth and enduring good. I'll start with the enduring growth one. And don't worry, I will pause for questions as well as we go through. But I think it's helpful to just touch on this bit first briefly. So when we talk about enduring growth, what we're talking about is those pretty rare firms that can grow their earnings at least 10% per annum for 10 years or more. That's our growth hurdle in this strategy. If you're able to achieve that, you would see yourself in the blue bar on this chart. So that's the top quintile of growers on a 10-year view. And that's important because there's a really predictable and demonstrable relationship between earnings growth and share price growth in the long run. Over the 31-year period shown here, those top 20 companies outperform the market by 7% per annum over any given decade. Now, that can quite clearly break down spectacularly in the short run, but if you are patient enough, that relationship does hold. It holds regardless of starting point, regardless of company classification, regardless of what level interest rates are at. Now, the challenge for us, of course, lies in identifying those companies ahead of time, rather than just being backward looking, as I've already criticized. And for that, I think what we try to do is ask different questions in our investment process. So, longer term questions, essentially ones that are focused on a company's resilience, on its societal contribution, and on our ownership priorities and the milestones that we seek as we progress through our period of ownership and our relationship with the company. Our mechanism for that is our 9-question compass framework, as we call it, which we apply to every investment that we analyze, and whether that's an existing one or a prospective one. And we have some slides later on in the presentation that go into exactly how we do that. But I think the important point to highlight is that this approach sets us apart, not just from other managers, but even from other Baillie Gifford strategies. So resilience is something that is a greater part of our investment philosophy, because we're seeking out those companies that can endure. So that means that our flavor of growth should be more moderate than some of the typical Baillie Gifford funds that you've probably become familiar with over time, and more moderate and therefore hopefully more reliable. Again, coming back to that point about this being a core allocation for clients within their growth equity mandates. Moving on to the enduring good piece. This is the other half of our infinity symbol, if you like. And I think that, it's the other thing that's gone awry in our industry. So growth investing has arguably gone awry in recent times. ESG is heading that way as well to some extent. And I think it's because, sustainable investing, it shouldn't be about downside and risk and about running away from controversy, which, clearly we're seeing a lot of firms very firmly focused on at the moment. It should be more about embracing the opportunities of a better future. So it's about facing into the big global challenges and finding companies that are solving those challenges. So we think those big challenges largely fall into 3 categories. So down the left-hand side of your slide, people, planet, and prosperity. And in every company that we analyze, whether it's an existing or a prospective one, we're trying to understand how that company contributes meaningfully to one of those big broad themes. And I say meaningfully, it has to be something that is moving the dial and that is financially material for that company. And I think, for your clients that are interested in investing sustainably, this is what they want. They want to see how their investments are making a difference. And we've gone to great pains to be able to show this both here and on our microsite, which there's a little QR code at the end of the presentation I'll take you to. Alongside those three themes of planet, people, and prosperity, we also think that there are two different ways that a company can make a difference. And I think this is something that really makes us quite different to other funds out there. So it's not just about what a company can do, so the products and services that they provide, so whether it's a transformative new medicine or a technology that helps cut emissions, for example, those are very much, product impact, what cases. But we also think a company can make a difference by how it does it. So the business practices, the behaviors and attitudes and the actions that those firms show. We think that can show leadership, they can be role models, and they can help really elevate standards across their industry and sometimes beyond. So I'm aware that everyone always gets the what column on this page, and there's some helpful illustrations of that shown here. But the how bit is a little bit less straightforward. So let me give you an example of that. The one that I think is actually not on the page, but the one that I think in the portfolio that really draws this out quite nicely is L'Oreal. So L'Oreal, quite clearly, we're not making an argument that cosmetics are a benefit to society. However essential some users may find them, it's not material enough for us to make a case around that. But what we do think is that L'Oreal, in its position as a very large multinational, it can exert pretty tremendous influence over its suppliers, over its competitors, even over its customers. And it can do that by having really strong business practices. So specifically in the case of L'Oreal, we think they're very much setting the standard when it comes to environmental reporting and goal setting. So they have pretty ambitious climate and biodiversity targets that extend not just to their own business, but right into their supply chain and right into the use cases. I think most companies out there are still not even reporting scope 3 emissions. But actually, so that's the type of carbon emissions that are, upstream and downstream from your own activities. But L'Oreal, in their case, they're actively targeting reductions to those scope 3 emissions because it accounts for about half of their total emissions. So as an example of that, you'll be aware that many L'Oreal products are used in the shower. So the energy used to heat the shower is actually a downstream emission of that company. They're actually partnering with a startup at the moment that's designing a shower head that really drastically reduces the water usage. They're also, in their R&D process, they're experimenting with new products like solid shampoos, which use less water, and also quick rinse products. I think this is something that could come to market fairly quickly. Quite frankly, a shampoo that washes out of your hair quicker than standard products. Less water usage, less energy to heat that water, all good for reducing those scope 3 emissions. Leadership on that kind of practice is I think something that can really make a difference. I think the other thing we look for is authenticity. So L'Oreal pretty openly admit that they're not sure how they're going to reduce their scope 3 emissions. But I think most companies out there haven't even given it enough thought to realize the challenges. So having that authenticity, having that open and honest conversation, you can see that when you read through their materials. And certainly when we meet with the management teams of these companies, that authenticity is pretty easy to spot. Another example of that would be Recruit. So Recruit is on the page here in the prosperity bucket of how. You might not have heard of it. It's a Japanese company. It's HR technologies, but you'll have heard of some of its websites. So Indeed or Glassdoor would be examples of their websites. Anyone out there who's been looking for a job recently will probably be on one of those too. And I think you could make a modest sort of what case or a product impact case for Recruit. it's very much improving the transparency and the efficiency of the labor market. But what gets us really excited there is that the company is proactively going further, trying to reduce discrimination, trying to help marginalized groups find work. So, for example, ex-offenders would be one group that they're focused on. I wish I had a poll question for this, but would you guess what proportion of US citizens have a criminal record? Would be my poll question. The answer is about 30%, surprisingly. So that's people who are pretty immediately excluded from the workforce, because of course one of the first questions you're asked on an application form is, do you have any criminal convictions? Recruit have recognized that, and they've realized that getting these people back into work can reduce reoffence rates, fivefold, in fact, as some of the research shows. And so they're actively making sure that there's less discrimination around these marginalized groups. So again, that's an example of that virtuous circle I showed you on the first slide in action. If Recruit is able to be market leading in the way that it makes a difference within the recruitment industry, that mission attracts and motivates its staff. It drives innovation on the platform, and then by bringing those people into the workforce and solving problems for employers as well, that's arguably widening their competitive moat. So very much an example of that virtuous circle I've talked about in action. So I guess the summary of that is that we're not just looking for impact, but influence too. And that ultimately gives us a wider perspective on sustainability. That broadens our opportunity set, and it allows us to build a more diversified portfolio. That means it can be a core allocation to growth equities for clients, but still with those really strong ESG credentials. So I'm going to pause there, and I'm going to see if I can somehow look at the chat while I'm sharing screen and see if there are any questions. And I'll also get to our second poll question, in fact, so I'll try and browse through all of this. But the second poll question, which hopefully someone can post into the chat for me, is what is the most important part of a sustainable investor's process? So is it A, idea generation? Is it B, portfolio construction? Or is it C, engagement? Or 1, 2, and 3, if that's more consistent with last time. Now, let me see if I can. Okay. So I think it's interesting because it's more mixed this time, but most people are skewed to number 2 or number 3, apart from Sanjay Badan there, who's come in with number 1. Well done to you, because I would agree with you. I think, for me, it's got to be idea generation. I think good portfolio management and engagement are absolutely important. They're all about getting the best out of the companies that you hold. So, making sure that you have exposure to the companies in the right size by portfolio management, and then making sure that you unlock their potential by engagement. But I think if you don't have the right holdings in the first place, then you're really struggling with both of those things. So for me, it's got to be idea generation. And that's something that we've very much reflected in our investment process, which I'll touch on briefly over the next couple of slides. I think it's possibly worth just telling you first of all about our investment team here. And I think I guess the key point to make on this slide is that this investment strategy has pretty significant resource around it. And I think about it in terms of sort of 3 layers that you can see on this diagram. So the first and most important layer is the blue one in the middle, which is our central investment desk. And I think what we're trying to do here is really deepen the integration of investment and sustainability research alongside each other. So what you see is our team is a mix of investors and sustainability specialists. Although I would say that in truth and in practice, all team members think about both of those aspects of an investment case right alongside each other. And really, we'd quite like to abolish job titles altogether if we absolutely were able to do so. But of course, organizations like ours need some degree of hierarchy. I think what we're trying to achieve there with that integration of sustainability and investment is just ensuring that sustainability matters are considered not before, not after, but at the same time as investment matters. And I think behaviorally that's really important. It allows us to focus on that which is material to the investment case, from whichever camp it comes from. Second, and around the outside of this slide and the dotted line there is our network of investment scouts. And I think these really direct links into our specialist regional equity teams are there to help with that idea generation piece. So really ensuring that our ears are close to the ground for the best new sustainable growth ideas. We're casting the net extremely wide here. And then I guess on that point, and not shown on this page, would be the third layer of our wider network, which is, I think we're over 125 investors at Baillie Gifford now, vast majority of which are sat together in our Edinburgh office. So that's, again, a very strong source of idea generation for us. And I would say, eclectic idea generation as well. That's really important to us. Lots of different ideas, different themes coming forward into the portfolio. That very much helps with the diversity of your holdings, helps with the resilience of the portfolio, and helps with that piece about lowering the volatility and delivering that more moderate flavor of growth. So that's the team. The process, so the process that they're putting into action, and this sort of follows on from the previous page. I'll not talk about all of these, but I think we're pretty clear on what we're looking for here. You can see in the top left-hand side, enduring growth and enduring good in this Euler diagram. Those rare companies, we've made that little overlapping portion deliberately very small because we think those companies are genuinely very rare. That gives our scout network pretty clear parameters to work to. In the course of their research within their respective regional teams, they're going to occasionally come across a company that they think fits that description quite nicely. And then they'll put those forward for the sustainable growth team. It could simply be a water cooler conversation, and we do sit very close to them all. Or we do have regular scout catch-ups as well, where we'll sort of actively elicit their ideas from them. And I think that really helps that process of really eclectic idea generation. So those names, if it's generated by the Scout Network, are taken forward for further research, specifically on the sustainability criteria, because that is sort of an added layer for us. And typically one of our sustainability analysts will pick that up. But at the same time, you can, of course, have idea generation coming from within our own team. And I'd say that probably is the most frequent source of idea generation for us. Now, where can that come from? It can be the output of investment trips. It can be interactions with academics is a nice different angle for us. Or even a chat with one of our inquisitive researchers, which we've got here at Baillie Gifford, which is, again, a differentiated source for us. It's typically not from reading a broker note, is the point I'm trying to make. Whatever the source of the idea generation, all companies have to pass through our 9-question research framework. So we call this our sustainable growth compass. And that just really provides a pretty consistent framework to help us consider whether a company will be capable of that enduring growth, and how it might deliver that enduring good at the same time. So how it might make the world a better place, and frankly, how we can help them get there through our ownership and our engagement in the course of our relationship with the company. So we've got, as I say, 9 questions in that framework. The first 3 are really about identifying the growth piece. So asking, how likely it is that the company can meet that 10% earnings growth hurdle for 10 years, and how much control it has over its own destiny. My colleague Toby likes to say that we like companies that make their own weather. That's what we're looking for when it comes to resilience of a company. And then finally, in that section, looking at market valuation, where is our insight? We use things like reverse DCF calculations to work out implied competitive advantage periods, for example, which allows us to sort of compare across the whole portfolio where we have a differentiated view from the market in terms of valuation. So that's the first three questions. The middle four are probably the most interesting, I would say. So those are the ones where we make it really clear how a company meets our definition of sustainability. So companies are actually scored on these middle four questions. We score them from 0 to 3, and we score them on 4 key sustainability criteria. And you can see this plotted in this little diamond diagram on the bottom right-hand side of the page. So products, practices, ambition, and trust. And the products and practices piece, we've already talked about the what or the how. That's very much aligned with that philosophy of company making a difference, either through what or how. So only companies that score at least a 2 on either of those can make it into the portfolio. And that's obviously contingent upon us not identifying any concerns around the other 2 pieces around management's commitment to making a difference, which would be the ambition piece, or the fact that we have faith in their capital allocation skill and how they'd execute on their opportunity, which would be the trust piece. And then finally, in the process, the last couple of questions are we consider how we might be wrong. So we need to identify in advance some watch points and make sure that we're monitoring those in the course of our ownership. And importantly for us, and lots of people answered in this vein, but what points do we want to engage with the management team on? We very much accept that there's no such thing as a perfect company, and that we can be a supportive influence on companies, to try and iron out the kinks over time. So that's something that is a very important part of our process for sure, but perhaps not as important as finding the companies in the first place. I would just finally point out that the analysis through the Sustainable Growth Compass, through the scoring process, is separate from the portfolio construction process. And I think that very much aligns with this idea that we're running a portfolio here that is designed to grow our clients' capital over the long term. So we have a single financial objective. Therefore, once companies have passed through the sustainability framework, ultimately the investment decision, the go, no go, the buy or do not buy decision has to be based upon the investment merit and whether or not a company can help us achieve that 2 to 3% outperformance target in the long run. I've said that engagement's really important. So we do have a separate slide on that. And I think the way I think about it is that I guess purchase and sale are 2 pretty significant milestones at either end of an ownership journey. But in between, we do have to take an active interest in the business, and we do have to keep up the dialogue with management teams. So I've included 3 examples here around our 8th question in the framework. So as I say, no company is perfect. What should be our engagement priority? And the 3 examples, the first one is one where we engaged prior to taking a holding in a company to answer some questions and ultimately did take a holding. Second one, we did the same thing, but we decided not to take a holding. And then the third one was engagement with an existing holding that then triggered a sale. And I think, when you're assessing, I talked earlier right at the very start about looking at all the sustainable funds out there and assessing whether their words meet their actions. I think if you can ask these questions of your sustainable managers and ensure that they do have examples of things that they've sold on sustainability grounds or after a poor engagement, I think that's quite a good indicator of how authentic they are. So the Starbucks one is quite a recent one for us because it's a recent purchase in the last 6 months. So I think it's quite an interesting case study, and it's also been in the news quite a bit. The investment case there was really, a pretty strong culture led by a very long-standing CEO, Howard Schultz, who's written a number of very interesting books, which some of you might want to pick up. But we felt that there was lots of scope to answer the first 3 questions in our process, the enduring growth piece, both at home in their US markets and in China. The stat from our research note on that always stands out to me was annual coffee consumption in the US is 300 cups per person per year, but in China it's just 12. So, and growing rapidly. So the growth opportunity for this business is definitely out in China. Having said that, if you go past any store in the UK or when you're traveling in the US, you see a queue outside, I would suggest that also means that even in these more developed areas, Starbucks is still supply constrained and in high demand. We essentially put Starbucks through our Compass framework in July, and one of the questions that came up was, so we looked at pretty exceptional stakeholder relationships, and that was one of the things that attracted us to it. Particularly their treatment of coffee farmers. So there are something like 12.5 million smallholder coffee farms globally, and if you can get decent pay to those coffee farmers, then you have the potential to lift those families out of poverty. And in doing so, raising standards across the industry, because actually Starbucks don't just target their own farmers, they do it right across the industry. They're raising standards on things like child labor, price volatility. So for example, they're flying teachers out there during school holidays to set up sort of summer camp type educational workshops, because child labor actually happens generally whenever the kids are off school and then they go to work with their parents and they end up working. That's generally how it happens. So Starbucks has been doing that not just for their own farmers, but across the whole industry. And again, coming back to that authenticity point, I think that shows real leadership. So that was all good. Employee satisfaction scores we looked at as well, they were superior to all their peers. But the one concern that we came up with was around unionization. So in our research framework, we decided we were going to engage on that before we took a holding in the company. And one of my colleagues flew out to the US, had conversations with the board chair on the topic, and essentially came away pretty reassured that management had recognized that they hadn't handled the situation particularly well. Some of the stuff that you may have read about in the press around clamping down on unionization efforts and so on. I think the summary is that they basically were slightly taken aback. They thought they were very good to their staff, and Schultz in particular didn't react to that well. So we made our feelings well known to them on that. And we were reassured enough that we actually took holding at the end of September, so a few months later, having done a bit more research. But I think the point I want to draw out is that it didn't just stop there. The illustration on your page doesn't end in September 2022. It goes on into last quarter, where they had their AGM, and there was a shareholder proposal requesting an independent assessment of their collective bargaining rights, and that passed. It was something that we had voted in favor of and against the management team on, and that's because for us that is quite clearly material to the investment case. There's potential for reputational damage there. We explained that to them in advance of the vote, and they were very accepting of that. And I think that that's something that now goes on to our engagement priority list for the coming year, and we can continue to monitor that. Now, I've got a red dot here, which suggests I've probably got a question. No, I've just got a prompt for a question. Well, how about I ask a question myself, then let's get to our third poll question. And I'm going to ask you, what drives market returns in the short run? Is it company fundamentals, A? Is it investor sentiment, B? Or is it C, macroeconomics and politics? So again, I'll give you a couple of minutes for someone to post that into the chat and for people to answer. Yeah, so we're getting a good flavor of responses there. I think everyone's agreeing with me this time. I think the thing that no one is answering is number one, company fundamentals. I guess the real answer is it depends, right? So in some environments, share prices are a good reflection of company fundamentals, but in others they aren't. And I think particularly where you have near-term certainty being at a premium, such as we have now, I think quite often sentiment and politics and economics and so on tend to waft share prices around quite a bit. And I think that's pretty understandable, right? So markets are pretty focused on the here and now at the minute. We've got rising rates, we've got a cost of living crisis here in the UK. All of that could potentially precede a recession. But I think that's quite interesting because for us, that presents a really big opportunity. And I'm trying to draw that out just in my final couple of slides here. Because, for us, our contention with this strategy is that you should be able to deliver superior returns by investing responsibly and sustainably. Now, there are loads of academic studies that back that up, but I think the sort of real proof of that lies in our performance. And you can see on page 9, I think this is, we've managed to do that. We've managed to outperform the index since the fund's inception. However, the numbers here are much less appealing than if I'd showed them to you a year ago. And the reason for that is that, inflation and interest rates rose during 2022, and we just saw market sentiment turn against growth investors pretty much universally, and especially those growth investments with cash flows that are very far out into the future. And that's exactly with our decade-long time horizon, that's exactly the kind of companies that we tend to be invested in. So what we saw during 2022 was a pretty remarkable fall in the fund value. So 35%, I think it was, maybe I'm thinking in dollars there. But it essentially wiped out what was previously a very strong record, both in absolute and relative terms. But I think, the thing is that for most of the portfolio, and there are some exceptions to this that we can get into, but for most of the portfolio, the operational performance of the companies, as opposed to the share price performance, it remains very healthy and very robust. And if I turn over to the next page, you can get a bit of a snapshot of that. So you can see here that, maybe you can see my cursor actually, balance sheets in the portfolio are very strong. A fraction of the gearing that you get in the index. The earnings growth in the portfolio is more than twice the level of the average company in the benchmark. So harking back to that point about 10% per annum for a decade, well, we're well above 10% per annum on a forecast basis from here. So that's very healthy indeed. And companies are continuing to invest heavily in their future. So this is something we refer to as our innovation ratio. So it's the ratio of capital expenditure and research and development costs over what they're paying out in buybacks and dividends. And you can see anything less than 1, arguably you should be a bit worried about, because it means companies are drawing down on their business. They're paying more out than they're investing in their own longevity. And you can see we're twice the level of the index there in terms of that long-term investment. So what I'm trying to say here is there is a big discrepancy at the minute between the share price performance of the funds at the portfolio level and the actual operating performance of the constituents of the funds. And we think that's a big opportunity at the portfolio level and at the stock level. We've been adding to a lot of the names that we think have been sort of unfairly caught up in the market turmoil, whether that's Spotify, Alphabet, Moderna is a big one, sitting back at close to pre-pandemic levels. And then we've been taking advantage as well of that market short-termism to take new holdings. We're finding that particularly in the more cyclical industries, so the ones where the market's sort of struggling to look through the cycles and towards the long-term success. So we found quite a lot of attractive entry points for new names like railroad infrastructure business, Wabtec would be one, advanced drainage systems would be another one. So we're certainly seeing this dislocation as an opportunity, and I think my argument would be that it's a similarly good entry point at the portfolio level at the moment. I'm going to stop talking, and if I do it in the next 60 seconds, I've done it bang on my 45-minute allocation. But a couple of points to leave you with. I think the first one is, Baillie Gifford, we are a partnership structure. We think that's the ideal structure for long-term investing. And we think long-term investing is the only way to really properly do sustainable investing on a forward-looking basis. And then in sustainable growth specifically, we have this really grand ambition, I guess, to have a portfolio that's sustainable in both senses of the word. So enduring growth and enduring good, and the two of those things being very much mutually reinforcing. So, who is sustainable growth for? It's for those people who want to direct their capital to some of those biggest challenges, the people, planet, prosperity. And it's for those who want to make hopefully pretty steady investment returns from here while doing so. I'm going to stop there and I'll see if there are any other questions. Again, I've got a few red blips and I will stop sharing my screen as well.
Thank you for that. That was very interesting. We have had a couple of questions come through. Okay. One's quite specific, one's a little more broad. I'll start with a really specific one. Just a quick question on L'Oreal. The person wants to know if they test their products on animals in China due to local laws. I don't know if that's anything that you are aware of.
There's no animal testing at L'Oreal. That's something that's stopped happening quite some time ago, as far as I'm aware. The specificity of the China point intrigues me, so maybe there's a headline out there that I need to go and Google after this.
Okay. Yeah, the next one feeds into a question we'd already got on the list. The question asker says, our concern is regarding the fund and the significant drop in 21 and 22. What do you think has contributed to the drop, and how have you stabilized the fund? I think you did speak a bit on that, but if you want to return to that, that's just answering that question.
Yeah, so I'll answer that in a very honest way. I think we probably ran our winners a little too hard during the pandemic. So the fund, the broader context for other people who've maybe not been around or known the fund for so long would be that we had very strong returns in 2020. So a number of the holdings were big beneficiaries of the pandemic and of lockdowns specifically. So whether that was, your Netflix that kept you entertained while you were locked up at home, or Amazon who could help you get your groceries. Those sorts of things did very well in the pandemic. And we continued to run with them right through 2020 and into 2021. And I think the thing that we didn't expect, frankly, was that a lot of the habits formed during the pandemic reverted more quickly and more fully than we perhaps would have expected. So Zoom, that we're using now, is a great example of this, right? Zoom's share price at the current time is back at pre-pandemic levels, and that's despite the fact that it has 10 times the revenues and 4 times the number of enterprise business customers. So that disconnect I've talked about between share prices and fundamentals is really evident there, and we're seeing that across a number of different holdings. So I guess for us, the lesson that we've taken from that was we ran our winners a little bit too hard. We let too much of the portfolio, we let our exposure to rapid growth names become too dominant within the portfolio. We got probably close to about 70% of the portfolio in broadly termed rapid growers. And what we've been seeking to do over the last few months is to really bring some balance back to the portfolio. I mentioned that we're finding some value in some of the more cyclical growers. The other category would be some slightly more stable names, some steady compounders that we've been adding into the portfolio. So the rapid growth names are now down at about, I looked at it this morning, actually, it was 41% of the portfolios on my count. So much more balance in the portfolio going forward. And that's towards that aim of delivering those less volatile returns. I think that's the thing that we're very aware of, is that the volatility was quite hard for our clients to stomach in this fund. And we want to moderate that going forward.
Mm-hmm. And has the fund set a climate commitment?
Yes, we have. That's actually probably something I should have mentioned on my final slide. Was there was a little QR code there. I'm not sure whether participants are going to be able to see these afterwards somewhere, but there's a QR code that shows, takes you directly to our client microsite. And in there you can find a statement of our climate ambitions. We're taking a pretty straightforward and transparent approach to that. So what we said is that we'll have 90% of our financed emissions on a net zero pathway by 2030. And the way that we measure that is we look for companies to have a science-based target initiative, accredited net zero goal of their own towards 1.5 degree pathway. This is why I'm pointing you to the microsite, because this stuff is pretty complicated stuff. But ultimately, what we'll do is we will count the number of companies that have that gold standard net zero target set out at the end of June every year, in fact, and we'll report on that in our sustainability reports that we issue every year. And we're going to lay out essentially what our goal is, how we're progressing towards it, where are the leaders and laggards, and a bit of analysis in that. So that's my project for next month, actually, is to start writing all of we call it our climate audit. I've looked at some of the data already, and we're making pretty good progress. So last year, when we looked at the number of companies that had a proper net zero goal, and this is astonishing given that we're talking about a sustainability fund here, but there were only 12% of portfolios that we would deem emerald, is the way we designate them. So, with proper robust targets. I looked at it again recently, and we've doubled that over the last year. So companies are really upping their game on net zero, and that's great to see. I think the thing to follow from there is not just that companies are disclosing adequately and setting the right targets, but how they're progressing against those targets. That's going to be the real proof of the pudding.
Mm-hmm. I was quite interested to hear about your 3 Ps of planet, people, and prosperity, and especially in the quick rinse shampoo idea. It's great. Do you have any other examples of great leadership, in your opinion, among companies that you're invested in?
This is where I bring up my portfolio page to give me a bit of a brainstorm. So management teams that have particularly impressed us recently. I think one that stands out to me would be Taiwan Semiconductor, Morris Chang there. And I think that is a business. If I was to pick out a company that has arguably the most solid competitive advantage of any in the world, I think TSMC would possibly be it, because of very good management and leadership over the years. Chang was involved, and it has just become utterly dominant within its industry. So TSMC, I should say, it manufactures semiconductors. So everyone will have heard about generative AI and machine learning and ChatGPT and so on, and those being produced on NVIDIA's GPU chips. TSMC, they're the ones that really manufacture the most advanced semiconductors, and without them, a lot of this progress just simply wouldn't be possible at all. So they're investing, looked at it the other day, $33 billion a year in capital expenditure. $33 billion. I mean, that's a sort of governmental number, not a company number. And they are making 90% of industry profits off about a 50% market share. Their nearest competitor is Intel, and Intel, frankly, they're trouncing Intel. Intel have started, and this is just a massive admission of defeat, at the 7 nanometer level and below. Intel have started outsourcing their production of the very most advanced chips to TSMC, to their competitor. So that's how utterly dominant that business is. The most advanced chips are below 7 nanometers. If you've got an iPhone 14 Pro, for example, it has a 4 nanometer chip in it. That's sort of absolutely cutting edge. NVIDIA's chips are about a similar distance at the node. So that business is one that I think is just exceptional, has a huge edge. I mean, one of the interesting things we've done to the portfolio recently, you asked about, well, someone in the audience asked about how we sought to sort of better diversify the portfolio in the face of the volatile performance that we've seen. So we actually recently took a holding in Texas Instruments. If TSMC is leading edge semiconductors, then I would say Texas Instruments is lagging edge. So it makes for example, the accelerometers that you have in your watches and your phones. So basically real world data chips, so things that translate speed, sound, temperature, and so on into digital form. And Texas Instruments, unsurprisingly given the name, is based in the US. We took a position in that, and we funded it by reducing our position in TSMC and NVIDIA that had done very well. And part of the reason we did that was that it gives us the same sort of broad exposure to the semiconductor industry, but it gives you a bit of a geopolitical hedge, because quite clearly there are tensions between the US and between China. I'm reading a book at the minute called Chip War, which there's a stat in there. You can probably tell by the fact that I'm rambling on about this. There's a stat in there that says that China now imports more by value in semiconductors than it does oil. I mean, that shows you the direction of travel for geopolitics going forward. So we ought to have thinking about that within our portfolio construction process.
All that talk of chips has made me a bit hungry. I've just had one more quick question come through just before we wrap up. You mentioned you probably pushed a few valuations too hard last year. What will change in the future? A better sell discipline, maybe? That's the question. Question
or suggestion, I think. I think that's absolutely valid. Yeah. So I mentioned the fact that we are looking at valuation in there. So whenever we recently revamped our 9-question framework, and we put valuation as a separate question in there. Catherine Davidson, that joined the team from another prominent manager in September of last year, brought with her, I think, quite a lot of valuation discipline, and the reverse DCF process, as an example, is something that she's brought forward. So that's adding another string to our bow there, another capability. I think on top of that, we want to run a slightly flatter portfolio. So my philosophy on this would be it's hard enough picking the companies, never mind ranking them. So having a flat portfolio where every holding can really make a difference to returns is good risk practice. We've improved our risk parameters on the fund a little bit as well, which hopefully will make sure that we stay closer within our guidelines going forward and keep those a bit tighter. So I think it's easy for me to sound as if I'm saying, market sentiment is dominating at the moment, and our performance has been poor because the market doesn't understand what's going on with these companies. That's not the case. There are definitely learnings for us, whether that's in terms of our investment process, or whether it's individual stock mistakes that we've made. And we want to reflect on those and make improvements where we can. Ultimately, we want to keep getting better at investing.
Okay, thank you very much. That was a really fascinating presentation, and thank you for your insights in a lively Q&A session. Now, before we wrap up, let's just take a quick look at those learning objectives again. At the conclusion of this session, delegates will understand the best single predictor of long-term share price outperformance, be able to reframe sustainable investing as a world of opportunities rather than downside protection strategy, and have learned how a business can be impactful, not just through its products and services, but its business practices too. Okay, that's all we have time for today. Thank you for your questions, and thank you again to Alasdair for joining me and for letting me and you folks at home grill you on with our questions. On that note, if your question didn't get answered, Alasdair and Baillie Gifford will do their best to do so after the event. Before we close up, I should assure you that your CPD will be delivered tomorrow. Just before we close, let me leave you with a teaser of what's to come from PA events through the summer and into early autumn. On July the 26th at 1 p.m, we have another digital working lunch, this time in association with Schroders, which qualifies for an hour of CPD. You can hear from Gillian Hepburn, Head of Intermediary Solutions, and Alex Funk, the CIO at Schroders. The digital working lunch series continues on the 9th of August with a presentation from Baillie Gifford's Rosie Rankin, who will be delving into the firm's Positive Change Fund. September sees the return of our ever-popular multi-asset roadshow, running on the 13th, 14th, 19th, 20th and 21st in Harrogate, Knutsford, Cardiff, Bristol and London. And on the 4th of October, which is my mum's birthday, brings a return of PA 360 North, this time at the Park Royal Hotel in Warrington. The all-day event features more than 30 speakers in 2 streams. It is the North's largest annual management conference for advisors, and we hope you can join us. So that's it for today's session. All that remains is for me to thank Alasdair once again for his presentation and answering your questions. And as ever, thank you to you, our readers, for your company this lunchtime. I trust you have found this session helpful and worthwhile. And if you did, perhaps we'll see you again next time. Goodbye.